Now I'm going to discuss with the golden rules of debit and credit with some example. So we can consider this example of a business transaction related to Mr. John, who is the owner of the business and want to start business. So what are the rules of accounting as far as the debit and credit is concerned? The personal, real, and nominal, three kinds of rules. The personal rule is related to the debit the receiver and credit the giver. Real, debit what comes in and credit what goes out. For the nominal, all expenses and losses debit and credit all incomes and gains. So personal account is related to all the persons, maybe the name of the person, name of the organization. Real things that we can see and touch, even the cash or like tangible aspects of the business, like say is the furniture, machinery, land and building. Nominal is related to all expenses and losses, incomes and gain. So business is proposed to be started. Mr. John proposed a business and ready to start the business. There are no elements affected by this transaction because this is the proposed. The money is not involved. So there will be no any transaction. Right. So now the started business with the capital $50,000 and when the owner, Mr. John has started business, he brought a $50,000 cash. So cash is coming in the business. So cash is real and debit what comes in. On the other side, who is giving this money? Mr. John is the owner of the business, giving this money in the business. So credit the giver. So that belongs to the personal account. So cash account debit to John's capital account. This is the explanation here that I have completed. Like John's capital, personal and is the name of the person. Then this is the personal account. Cash is the tangible aspects of the assets, and this is the real account. This is the first transaction that we have done. The second transaction here is bought furniture for cash at $25,000. So furniture has come in the business, right? So debit what comes in. This is the real account. So furniture account debit. Cash has gone from the business, right? So this is credit what goes out. So that is the cash. So the two elements are affected in the transaction, furniture account debit and the cash account credit here. So in the explanation, you can see the furniture is the tangible aspects of the business, and this is also assets and comes into the real account. And the cash account we can see and touch the same thing. This is also the real account as furniture is. So one is coming and one is going. What is the meaning? It means that the value of money is increasing in case of furniture and the value of money is decreasing in case of cash. So when there is an increase, we will debit the assets. When there will be a decrease, then we will credit the assets. The third transaction we have, this is also the cash transaction. We bought goods for cash, $25,000 from Messrs. Leo Brothers. So since the goods are bought by paying cash, the value of goods increased by $25,000. And the cash available with the business would reduce by $25,000. It means cash has gone from the business and the purchase we have purchased goods, and goods we can see these are the tangible aspects of the business we can see and touch. So debit what comes in and credit what goes out, right? So in this case goods are tangible and we can consider this as a real. And on the other side the cash is going from the business, so cash is also tangible and this is also the real. The next journal entry we can see here. Before going to the next one, just remember one thing. Vendor name is irrelevant in cash business or cash purchases. So though the goods have been purchased from Messrs. Leo Brother, their name has no relevance while the transaction is being considered for accounting purpose since the purchase is for cash. Right? So next we have bought goods from Mr. Shaun on credit for $10,000. In the previous entry, we bought goods on cash, but now in this entry, we bought goods on credit. Whenever that we bought goods on credit, that definitely that the name will come in the business. So that will become our creditors because we have purchased goods and definitely we will pay money. So that will be our account payable. So in this case, what is happening? We are buying some goods. The goods has come in the business. This is the real we can see and touch. And for the real account, debit what comes in and credit what goes out. In this case, the goods are coming. So that's why the value of the money has increased and debit what comes in, right? So this is the interpretation according to the increase or decrease of values of assets, as well as according to the golden rules of debit, golden rules of debit and credit in accounting. And Mr. Shaun is the account payable. Definitely, we will pay money to Mr. Shaun. This will become a liability of the of our business. Whenever you see find any name of the person, name of the organization, name of the bank, even name of the owner, then definitely that will be the personal account. So Mr. Shaun is a personal account and is a person, and it falls under the personal account. So credit the giver. In this case, what will be the rule? Credit the giver. Mr. Shaun has given goods to us, so that's why this is credit the giver. So next entry that we have, sold goods for cash. So once the goods have been sold on cash, we receive cash from other parties, and the goods has gone. Whenever the goods has gone from the business, right, it is considered as a sale. So cash account debit to sale. Cash is real and the sale is also real. The stock is also real. Both we can see and touch. So both are real. According to the rule, debit what comes in, cash is coming. Credit what goes out, and the goods are going. So that's why cash account debit to selling of the goods. So remember again, like buyer name is irrelevant in the cash sale. Whenever there is a cash sale, so the buyer name will not be considered, because that we have received cash, no more buyer name is required. Okay. So next we have sold goods on credit to Messrs. Sam and Company. So $10,000, this is the amount, and we have sold goods, but we have not received money from Messrs. Shaun and Company. Definitely in future we will receive money from him, right? So when we will receive money from him, definitely it will be accounts receivable for our company, and will comes on the asset side of the balance sheet. Since goods are sold on credit, right, value of the goods are decreased by $10,000. Yes, right. So the value, the stock has decreased. Definitely we will write to sale. A new asset in the form of a debtor who owe us is created. So in this case, Messrs. Sam and Company account is created. The new asset is identified by the name of the organization which purchased goods on credit. That is Messrs. Sam and Company. So Sam and Company is the name of the company, right? And we will definitely receive money from him later on. So in this case, like goods are tangible, real, and the name of the person is the Sam and Company, name of the organization is here, then this is the personal. According to the personal rule, we will do this one, debit the receiver and credit the giver, right? So in this case, what is happening? So Messrs. Sam and Company is here. So we have sold goods to Mr. Sam and Company. He is the receiver of the goods. So debit the receiver, and the sale has gone from the business. Sale is real account, credit what goes out. So that's why this is credit. Right. So next we can see paid cash into bank. It means the cash we have deposited in the bank. So already we have cash. So cash is real and the bank is a personal account, right? So when the cash is deposited in the bank, so what will happen, right? So cash balance will go down and the bank balance will go up. So who is receiving this money? The bank is receiving this money. So bank balance has increased. Whenever we say the assets value is increased, it will be debited. So bank account debit to cash. So cash is real. So credit what goes out. Right. So this is the depositing money into bank, $30,000. Paid cash to Mrs. Shaun, $5,000. In the previous case, that what we did, we bought goods on credit, but now to Mr. Shaun, $5,000 we are paying cash to him, right? So whenever that we are going to pay cash, first thing that comes in our mind that the cash has gone from the business. Cash is a real. So credit what goes out. So this is the second entry that we have explained here, this one. Mr. Shaun, that from whom that we need to pay money to him. So that were our accounts payable. Now we are debiting it because Mr. Shaun is receiving this money. So debit the receiver and the credit what goes out in this transaction. Received cash from Messrs. Sam and Company on account, right? $8,000. So in this case, we have received $8,000 from Messrs. Sam and Company. So cash is received by our company. Cash has come in the business. So cash account debit. On the other side, to Sam and Company, because that from Sam that we need to get money, right? So after maybe a couple of months that we have received money. Why we are receiving money? Because that we have sold goods on credit. When we sold goods on credit, then we see that the list of debtors or list of account receivable that comes on the asset side of the balance sheet. So on the asset side, there were $8,000, but once we received it, then we will discredit it. Whenever that we are going to credit some assets, the value decreases, right? So let's say $10,000 minus 8,000. Now 2,000 is our sundry debtors or account receivable. Okay, so this is that some of the examples that we have taken to make you understand regarding how to put the transactions into the journal entry on the basis of the rules of accounting and debit and credit rules of accounting.